Hey guys, Brent Hicks here. First and foremost, mortgage banking is dead. I'm going to get to that in a second. Let me give you a little bit of background and a little bit of color. So I've been in the mortgage banking industry for over 20 years. 1997 was the first year I originated a loan. Over those 20 years, I've personally originated well over $1 billion in production. Over 10,000 families have we helped to serve. And we've had years that have been all over the map. One year I was number 13 in the country. I originated $176 million in loans, and one month I had almost $33 million in personal production, all purchased in one month. I don't say that to be narcissistic. I'm providing a little bit of context as we get into the subject as far as color and background and experience and history. So let me get back to the original topic. Mortgage banking is dead. Mortgage banking isn't dead, guys, but the way that we know mortgage banking is going to change forever and has changed forever. You know, there's evolution built into everything. And the one thing that I know that's constant is change. Whether we like it or not, change is constantly happening. Consumers are constantly looking for bigger, better, faster, cheaper, easier. And that forces evolution, that forces change. What we're seeing right now in the mortgage business is unprecedented. I was fortunate enough over the last 20 years to have gone through multiple cycles. We've gone through booms and busts and refinance booms and purchase booms or housing booms. You know, during that period of time, I witnessed 2007, 2008, what happened in the mortgage meltdown. And during that time of my life, right, it was absolutely crazy. We went from having our very best month ever. I think we funded $32.7 million personally, and my branch did about $60 or $70 million in production that month, to 4 or 5 months later, the entire mortgage business started melting down. And, at that time, I drank the Kool-Aid, right? I was young. I was 32 years young. I had experience, but I didn't have real life experience. And I thought that, the show was never going to stop, right? It was going to continue to go on. At that point, I didn't know how to read the tea leaves. And during that mortgage meltdown, my wife and I had saved a lot of money. And during that period of time, we lost millions of dollars. And during that period, we wanted to look for the lessons. I believe everything in life is either a teacher or a tormentor. We can let the things that happen torment us, or we can take responsibility of it. We can take ownership of it, and we can learn from it. And at that time, it was stressful, but I really believe that I was blessed. I was blessed that at 32 years old, that I was learning lessons that most people may never learn. I call it one of my gray hair experiences. And, we add people to our boards that have gray hair. It's the proverbial experience that we're looking for to surround ourselves with people that have that kind of knowledge. And during those years, we really learned a lot about what was going on in the market. And I knew that whenever I saw a market shift again, I could take advantage of it. Instead of being wiped out by it, I could actually participate in it. Same thing happened in the stock market. When you looked at the stock market in 2008 and 2009, and it bottomed out, and people were panicking, and they were pulling money out left and right. Rothschild, what he always says is the time to invest is when there's blood on the streets. And, so many people lost a lot of their net worth. Had they left the money in the market, it rebounded significantly, and we know where the stock market is today. Warren Buffett made tens of billions of dollars, right, having experience. So, I'm talking a lot about that because what I'm going to provide you with here over the next little bit is my belief as to what's gone on in the market so far and what's going to happen and how we can take advantage of that. Compression. That's a buzzword. We're starting to hear that a lot. Compression has happened throughout the last 20 years in the mortgage business that I've been in. Usually if the cycles are a little small, right? You come out of a refinance boom, you get some compression. At the end of the year, Q4, beginning of Q1, there's some compression that happens because the population of loans shrinks, yet the number of loan originators and companies don't shrink, right? So people trim up their rates, their margins come down some, it gets a little more competitive, and as we roll into the summer months, things get to be a little looser and a little more normalized. This time around, compression in 2017, we started noticing at the third week of August. And coming out of summer, we started noticing that the competition was fierce. People were cutting rates and fees left and right, and it became a really tough environment for us. And we were hopeful that it was just a short term. Come December, January, we really started to know that this is long term. This is a systemic change. This is not something that's just a season that's going to be gone. It's something that's forever changing the way that we as retail loan originators, branch managers, loan officers in general, and mortgage companies, it's changing the way that we do business. I think it's the perfect storm as well, because what's happened here is you've got, the last 10 years, we've had a huge run up in housing. We've had a decade long of low interest rates that's created all kinds of refinance activity. We've seen the number of loan originators bloom and blossom, right? A lot of people came back into the mortgage business or got into the mortgage business during the boom. Now all these companies are set up. They've got their shop set up. Refinances are getting decimated, right? They're down significantly. And what's left is a lot of purchase business. And now we've got all these people trying to compete for purchase business. And what they're doing is they're discounting their pricing and rates to try to keep the doors open, to try to stop and prevent massive layoffs. You see the Amazon type model that's happening as well. So, when Amazon wanted to get into diapers, they tried to buy diapers.com and they wanted to compete with Walmart. They didn't sell to them. Diapers.com decided not to sell. And what Amazon decided to do was put them out of business or do their best to take over the market. And so for years, they lost money on every single sale of diapers because they could sustain that, but they knew that their competition couldn't. Now Amazon, is the number one seller of diapers and the number one seller of many things on the planet, and definitely in the United States. But what's going to happen here is mortgage lenders aren't going to be able to sustain, right? Most companies are in danger right now. So if you read the Chrisman report, he's really been keened into it here over the last couple of weeks and months. He's talking about MBA and what happened there, and everybody talking about LO comp coming down and margins. Statistically, the Q3 of last year, the average mortgage banker made 40 basis points net income. Q4 of last year, that came all the way down from 40 basis points to 9. What we've heard is Q1, according to the MBA, is that the average mortgage banker lost money. And we've also heard from warehouse lenders and other people that, 60, 70, 80% of their clients lost money and are losing money. That's not sustainable, guys. And so what happens there, if you're a mortgage banker and you've got warehouse lines, when you go to close a loan, call it a $200,000 loan, and you fund that $200,000 loan, the warehouse line may give you 100 cents on the dollar of whatever the loan amount is. Then, you sell the loan, you pick up the gain, you cover all your cost. As you start to lose money, these warehouse lenders start to really pay attention because it's their money that's on the hook, right? They've got some reserves from the lender that they're holding, but as they start to lose money, those reserves start to dwindle. Then they start to become highly sensitive, and they either can cut people and cut their warehouse lines, or what they start to do is they start to haircut every loan. So imagine you're a mortgage bank and you're already losing money on every single transaction you're doing. Now your warehouse line comes in and says, "Oh, you're losing money. We're not as comfortable. Instead of funding you at 100 cents on the dollar, we're going to fund you at 97 or 96." So that means for every $1 million that you're funding, they're taking 4% out. $40,000. Imagine you're doing hundreds of millions of dollars every month, and now 4% is coming out before you sell the loan. You still had the cost to pay the loan originator, pay your processing and underwriting, closing, funding, shipping, cure tolerances, all those things. The haircuts will put people out of business. And so what I believe is happening, and it's going to continue to happen, is 40 to 50% of originators are going to make a move. They're going to change, and they're going to move to someplace else. I think 30 to 40% of mortgage bankers are either going to get consolidated, aggregated, close up shop, or get out of the business altogether, file bankruptcy, because this is unsustainable. And the shift is happening all over the place, right? It's not just happening in our mortgage business. The shift is happening in real estate. I spend a lot of time masterminding. For the last decade, I've been part of huge mastermind groups with other top 100, 200 originators in the country. These are people that have also done billions of dollars, and we share a lot of information. I'm in a real estate mastermind where the average real estate agent makes $2.5 million a year. And the number one topic on their mind is compression and the market changing and the discounters and the fact that their fees have come down because you've got other companies willing to list the houses for free or do 1% listing. And they've got the technology as well to help them drive that. That's not going to change either, guys. And so the way of the world for mortgage bankers, loan originators, the retail guys has changed, and it really has changed forever. What I'm going to do is I'm going to help give you 5 ways to not just survive, but to thrive in this coming environment, right? And there are some key things that we need to be aware of, acutely aware of. Don't be an ostrich. Don't stick your head in the sand. Don't think that you're invincible and that LO comp and your LO comp can never change, because it's going to. And everything that we do is going to change, because what we need to do is we've got to be able to get highly lean and be able to give our consumers a really sharp price, because that's what they're looking for. You know, the cost of originating loans. Let me give you a statistic. Years ago, compliance costs before Dodd-Frank and before TRID, that may be $100, $200 in compliance per loan cost. And then you've got your top of the funnel, your corporate allocation costs for underwriting, closing, funding, shipping, post-closing, things like that. The cost of manufacturer loan may have been a couple of $1,000s, may have been $1,500. Now the average mortgage costs anywhere at the corporate level, anywhere from $2,000 to $4,500 to manufacture that loan, to cover all those costs, the compliance costs, the cure tolerance costs, post closing, all that stuff. If you're a $250,000 loan and the cost to manufacture corporately was $4,000, I mean, you're talking 150 basis points. That's 150 basis points that has to be added on top before anything happens at a branch level, before any LOs get compensated, before any LOAs, processors, administrative staff, before the SG&A, which is salaries, general administrative, before any of that stuff gets paid. And all that does is put us further and further away from our consumer and delivering a really sharp price, which is what the consumer is looking for, right? So 5 things that we can do to not be ostriches, to not just survive, but to thrive in this coming environment that's happening to us right now. Number 1, you got to get to the top of the funnel. What that means is, don't wait for the fish to come into your net. Don't be sitting there waiting for someone to hand and spoon feed you a lead. You've got to be able to get out there and get to the top of the funnel. To be able to find buyers before they become buyers, to find buyers before they have real estate agents, before they've been pre-approved, right? Those buyers that you can get pre-approved on the front end and then give those to a referral partner is the best gold in the world that you can possibly have, right? And there may be people that do some co-marketing where you do a 50-50 split in marketing campaign with an agent. I can promise you, anybody that you're doing business with would much rather you give them either come list me's, which are people that are ready to list their house that you come across or find buyers that are pre-approved and ready to go find a house. I mean, it absolutely is the best thing we can possibly do. There's also a huge trend in big data. There's so much big data out there. I mean, I could tell you statistics on every real estate agent in our market. I can tell you how many houses they've sold, when they sold them, what address. I can tell you how many buyers, how many sellers they worked with. I can tell you statistics on loan officers. I can tell you statistics on builders. I can tell you what mortgage companies they're actually closing and funding loans with. There's so much data out there, guys. But what are you doing? What are we doing as originators to use that data to our advantage and to be able to go find the consumers instead of waiting for them to find us? Number 2, products, programs, and differentiation. We've got to find the products that help us differentiate ourselves. The days of just being well-versed in Fannie and Freddie and your Ginnie products, your FHA, your VA, your USDA, has to change. And we always see the pendulum swing. So during 2005, 2006, we saw credit open. It got ridiculous. There's 100% no doc loans, 100% no ratio investor products. And as that closed, right, the pendulum swung really far in the other direction. Now we're seeing things normalize. Loans are performing better than they have in decades because we've got real buyers with real money, and they're not speculative. And so we're seeing products come back into the market. We're seeing programs will allow someone with bank statements that wouldn't traditionally qualify. 100% DPA loans, right? So down payment assistance programs that are out there that can help someone get into a house that normally wouldn't qualify. It may be a reno loan. It may be a 203K loan that you learn how to do. There are a vast amount of products that you can become an expert. A 95% jumbo product that other people aren't offering. Get out there and get yourself educated and start offering products that get you in front of referral partners, get you in front of builders and real estate agents that you can provide value and become an expert. And you also get into the game where it's just not a commodity because you're providing something that other people can't provide. And so we can take the commodity aspect somewhat out of the equation. 3, stay lean. There is way too much fat built into the model these days, guys. Over the last 10 years, right, each company, a lot of companies have gotten bloated, and you got to make sure that your company is aligned with you and aligned with your consumers. And that means we have to operate differently. We need to be able to get technology to help us drive down costs, drive efficiency, and drive our cost per loan down, which means real basis points and material basis points that we can then deliver a better price to our consumer. Executive comp, right? If you're with an organization that may have 6, 7, 8 layers of executive comp, you've got, an SVP, an RVP, an EVP, regional, a divisional, all these different people between you and the company. All of those people are salaried and they may have some type of basis point override. There could be 40, 50 basis points there in fact that puts you that goes between you and the company and between you and your end consumer. Right? So we've got to be aligned. We've got to be able to be with an organization that's maniacally focused on driving down costs and driving efficiency. And you got to make sure at the branch level too that there is efficiency being gained, because every penny that we save is a penny that we can put back into our consumer's pocket. Number 4, own your own technology. I'm seeing so many fintech companies get into the space or start to really do a good job. And fintech companies in general, you're seeing it across the spectrum, right? In the financial advising industry. I mean, they're coming everywhere, and technology becoming more efficient, becoming more autonomous becomes increasingly more important. I believe that I liken what's going on to what's going on with Tesla and what's going to happen in the rideshare market. So I firmly believe that as Tesla continues to evolve the autonomously driven vehicle, that once they figure that out, they will disrupt the auto industry completely, and they'll disrupt the rideshare. Why do I say that? As a rideshare, right, what are the 2 most expensive things? What are the 2 biggest costs for Uber? The driver and gasoline. When you take a driver out and you take gasoline out, you've now got the cost of the vehicle itself that gets amortized over a period of time, and then you've got your technology and your normal, administrative cost. You've taken so much of the cost out. The same thing I think is happening in the mortgage space, right? So you've got financial technology companies driving autonomous ways to do business, Rocket Mortgage, that is going to allow the customer to be able to self-serve, right? And continue to be able to deliver a better price. That does lead me to number 5, which is the hybrid model. I think the evolution of our business as retail originators and retail branches is we have to embrace technology, and I think our consumers want a consumer direct price, but they want a retail experience. And so how do we blend those 2 models together, right? We create a model that we allow the customer to do some self-serving. We allow them to go online and to append and attach their documents, to be able to go and constantly see what's needed, and they self-serve themselves, all while we still keep our hands on it, while we still act as a fiduciary and give them experience and knowledge, and we can watch the process and make sure things go through properly and they've got a point of contact, but yet we're not having to get our hands into it 15, 20 times. Your processors can handle double the volume, your LOAs. I mean, all of those efficiencies are needed to allow LO comp to be able to stay as high as it possibly can and to be able to still deliver a price to our consumer that's going to make them want to do business and make them want to come back to you. Over the next months, guys, I'm going to continue to deliver videos, content, podcasts, blogs. Really, I want to be able to provide you with as much experience. I want to drive deeper into each one of these topics and let you know what's going on and how you can protect yourself. Like I said, there's 5 ways that you can not just survive, but you can thrive in this environment, and I want to make sure you're taking advantage of it. I'm going to also offer you a free ebook. So if you put your information in, I'll send you a free ebook on that topic and how you can thrive in this environment. Look forward to continued dialogue. Have a great week.